Good morning. It's Jeffrey Christian of CPM Group. It's about 11:55 in the morning, almost noon, here in New York on Friday, the 28th of March. Gold and silver, platinum, and palladium prices have risen sharply, really starting yesterday. Um, the stock market also has been falling sharply. The movements have reflected tremendous and increased anxieties and uncertainties about the risks, economic and political risks facing the world, a lot of which stem from policies of the Trump administration and issues that have been going on. This morning, the personal consumption and expenditures data came out from the Bureau of Economic Analysis. It showed weaker economic activity and higher inflation, which exacerbated the already strong movement upward in prices. Gold got as high as $3,124 on basis the June Comex futures contract. It's around $3,103 as we speak now. Silver got to $35.45 or 49 cents, almost 35.50. It has come off, and I think it's right below $35 an ounce right now as we speak. I wanted to talk about gold facts and fantasies, going through some of the things that we discussed when we released our gold yearbook on Tuesday of this week. If you did see it, there's about a 90-minute video that we posted of the briefing on the gold yearbook launch with a question and answer period, about a little over an hour of discussion of the gold yearbook. This is a copy of the gold yearbook that I printed out. It comes out as an ebook, and the last page tells you how you can get it printed and bound at a copy shop if that's what you want. I wanted to go over some of the things that we pointed out that were inaccurate about gold and the accurate assessment of what's going on in that gold yearbook. But given the market conditions, I'll also be talking about some of those things, and I'll throw in some other cute tidbits. First off, Comex, New York, is not running out of gold. In fact, we have 40 million ounces of record gold inventories that are reported to the Comex, either registered or eligible to be registered, record amounts of gold. There are 9.5 million ounces of open interest remaining in the April Comex gold futures contract, which will become deliverable on Monday, the 31st of March. There have been people who think that there's going to be a great taking of delivery and that metal will be taken off. That doesn't necessarily reflect the way the Comex really works. There could be very high deliveries, but most of the metal that gets delivered from shorts to longs via the Comex clearinghouse will stay in the depositories, not necessarily people who are using that metal. Some of the metal may come out. Some of it may be sold to bullion banks that need to deliver it, good delivery gold, to the New York Fed for holdings by central banks, because we've seen some central banks starting to move gold into the New York Fed to keep it away from Europe and as far away from Russia as possible, as they say in Eastern and Central Europe. But most of that gold, even if there are deliveries, a lot of it will be rolled forward. But even if there are deliveries in the April Comex gold futures contract, most of the gold will probably stay there. And the New York market's not running out of gold. And this is just the gold that is at Comex registered depositories within the New York Comex capture area, which is the northeastern part of the United States. There are other depositories around the United States and Canada, the Royal Canadian Mint. There are depositories in Florida, California, Nevada, Idaho, and other places that have additional metal of gold. There's plenty of gold out there. There have been people who have been saying that London is running out of gold or unallocated gold because it's all being transferred to either China or India or New York. That's not necessarily the case. This is another chart from our gold yearbook. The blue part is the gold that is at the Bank of England. They have the London Bullion Market Association started publishing data, collecting and publishing data in July of 2016. And you can see that the blue part, the amount of gold held in the Bank of England, is down a little bit over the last few months, but it is basically in line with what we've seen over the last 9 years. The amount of gold that is held in other depositories within the LBMA capture area, which is basically metropolitan London, at LBMA registered or recognized vault and depositories, has it rose in 2015 through 2021. It's come back off. It's higher than it was in the 2016 2018 period of time. So London's not running out of gold. And of course, there's other gold. There's gold that is stored in depositories outside of the LBMA capture area. There's hundreds of millions of ounces of gold stored in Switzerland and other parts of Europe and in other parts of the world. I thought this was cute. The Trump administration accuses the EPA of squirreling away $20 billion in gold bars. And this was from a CNN article. Shortly after Lee Zeldin took over as the head of the EPA, he accused the previous administration of the EPA of hiding $20 billion worth of gold bars in a Citibank account and vowed to claw back that gold for the Treasury. In reality, what he was referring to was that Congress had budgeted $20 billion in appropriations to the EPA for a given fiscal year. It hadn't given the money to the EPA, but it had authorized the EPA to spend that much money. There was no gold involved. It was a chit on the Treasury's balance sheet that, hey, the EPA has the right to use up to $20 billion in a given fiscal year. And the really ironic part is that Lee Zeldin had been in the Congress when they voted for that appropriation. That's how intelligent this market and this government have been. Now, we hear that central bank demand is strong, and it is. Central banks on a net basis bought about 8.4 million ounces last year. That's a lot of gold. It's down from 13.9 million ounces, and it's down from the volumes of 10 to 14 million ounces that we've seen between 2021 and 2023. It's in line with the roughly 10 million ounces on average that we've seen central banks buy on a net basis as a group since around 2008. So you're hearing marketing groups say that the gold price really has been driven by stronger central bank demand, not investment demand. And that's just not true. And oh, yes, when investors start buying too, then the price will go up even further. That's not been the case. It's investment demand that's driving gold higher. Central bank demand is high, but it's down from 2023 last year. This is not a wave of a central bank gold buying. Here's the actual data. 13.9 million ounces of net purchases by official entities, monetary authorities, central banks, ministries of finance in 2023, and 8.4 million ounces in 2024. That's a 40% decline in the volume of gold being purchased. Now, the price of gold had risen from an average of $1,952 in 2023 to $2,000 $395 in 2024. That's a 22.7% increase in the average price of gold. Not that the central banks bought at the average, but using that average just to calculate the volumes, net central bank gold buying declined from $27 billion, my apology, $27 billion in 2023 to $20 billion in 2024. That's a 25.8% decline in the amount of money that central banks were putting into their gold reserves. It's not the same 20 billion, I don't think, that Lee Zeldin thought the EPA had, but maybe that's where he got the number. It's hard to say, and my job is not to try to explain nonsensical information that other people say and believe. As I said, it's been investment demand, strong investment demand, that has driven the gold price and the silver price higher, not only today, but over the last year or so. We saw central investment demand, net investment demand of physical gold was about 36.6 million ounces last year by our estimate. We have it going up to about 39.6 million ounces this year. But that 36.6 was up from a little over 20 million ounces in 2023. Okay? So what we're seeing is strong investment demand. And that investment demand is being driven by the greatest amount of uncertainty and anxiety that investors around the world have had since December 7th, 1941. The world is more unsettled than it has been since Pearl Harbor. And investors, large and small, around the world have been buying gold. And one of the other myths that you keep hearing is that institutional investors in North America have not been participating in this rally. That's actually not true. They've been very heavy, which is one of the reasons why you've seen a lot of gold move into the United States and Canada, into North America, not only from London, but also from Switzerland, Hong Kong, Singapore, and other places where a lot of gold's stored. It's really investment demand. I want to show you this one. It's not just gold that attracts people who don't know what they're talking about. About 34% of Americans believe that the Great Depression started under FDR and not 4 years before he was elected. This is GDP, real GDP, in the United States from 1924 through 1940. And you can see under Calvin Coolidge, GDP was rising. Those were the roaring 20s. There was a lot of money coming into the world. The income inequality was rising. It almost was as high as it is today. Under Herbert Hoover, we saw the Great Depression emerge. It started in 1929 and it went into the 1930s. FDR took over in March of 1933, and we started to see the New Deal bring people back to work. At the end of the Hoover administration and the beginning of the FDR administration, unemployment had gotten as high as 40% in the United States and really around the world. By the time FDR took over, I think that the unemployment rate had actually dropped to around only 25%. You had an enormous, it was the Great Depression. It was a very bad time. And the social safety nets that government provide today, which were created under the New Deal under FDR to get us out of the Depression, they didn't exist prior to the New Deal. Now, it's really appalling that 34%, a third of American adults, think that the Depression was caused by FDR. But that's the power of propaganda and the delusionary aspect of political true believers. And it's not just on that side. A recent poll showed that 18% of the people polled, and I think it was a very skewed poll, 18% of the people who were polled in a recent poll, thought that the New Deal, which was what FDR's package of new programs was called, was created by Alexandria Ocasio-Cortez, the current representative of parts of the Bronx and Queens in the Congress. The New Deal actually started in 1933. So have a terrible world of misinformation. And I'm preparing a presentation for one of these videos on misinformation, disinformation, how to spot it, and how to avoid it. You avoid it by you don't look at stuff like King World News or the garbage that you see a lot of marketeers putting out. Gold prices, as I said, we are at a new record today. We've gone from $3,020 a few weeks ago to $3,124 today, this morning. It's about $3,103. CPM Group's view is that the price could stay strong, could go to $3,200 in the next few days, between now and, say, next Wednesday or Thursday, because of all of those political and economic uncertainties, and because we are moving into the first delivery period of the April Comex futures contract. By April 3rd, April 4th, we think the price could come off. We wouldn't be surprised to see it, fall back to 3,090 or 3,040. But given that the economic and political problems are not going away, we expect the price to stay strong and to move a little bit higher. We have been saying for months that we thought that the gold price and silver price would be strong in the first 3 or 4 months of this year, January through April, and then back off a little bit on profit taking as people start normalizing their anxieties about the current state of the world. Current state of the world is not necessarily going to get better in the second and third quarters, but markets may calm down a little bit and learn how to live with the state of the world. And then we do think that things will get worse. We are still expecting a recession with high inflation being 4% to 6%, not 9% like we saw in 2021, and not 14% like we saw in 1979. But inflationary pressures coupled with recessionary pressures going into 2026. We do expect that. As I said, so this is a chart I pulled up. I just ran across this while I was looking for something else, and I thought I'd pull it out. This was 2011. Now, those of you who remember, we went into a very deep recession in late 2007, which lasted into 2009. It was the longest recession that we had since the double dip recession of 1980, 1982, which was actually 2 recessions because there was a little bit of a recovery in there. We went into a recession in 2007. We had the Great Recession, very deep recession, very painful recession on a global basis. We had the global financial crisis, 2008, 2009. We had the bubble burst on the collateralized mortgage obligations and other collateralized debt obligations. We had the Hank Paulson Treasury not deal with the mortgage crisis as he should have, but rather pump a couple $1 trillion into the banks to keep them afloat so that they could deal with the mortgage problems that they had created in an extremely inappropriate fashion. Then we had a series of sovereign debt crises in Europe, Ireland, Portugal, Spain, Italy, Greece. And the ECB was not structured and did not have the legal capacity to issue Euro bonds to help out there. So it was a particularly bothersome period, 2010, 2011. And then we had the massive growth in debt in the United States, both federal and private debt. so that the government raised the debt ceiling in August of 2011. S&P downgraded U.S. government debt a couple days later. And the gold price, which was trading at a record price of 1,500, 1,550, shot up to a new record of around $1,900 an ounce in early September. And then it came back down. And it came down over the course of the rest of 2011. And then it fell sharply in 2013, back to around $1,240, and then ultimately to around $1,040 or $1,080. I just wanted to point that out because debt crisis in the U.S., and it may not be a debt crisis this time, it may be something else, but the government misbehavior and bad behavior of 2008 spilling over and causing the gold price to spike sharply higher and then come back off. And that come back off is very important to pay attention to if you want to think about it as opposed to believe it. Silver prices have gotten over $35. They got up to about $35.49 this morning. Our expectation is that they will rise perhaps sharply. We could see a pullback in the first 2 weeks of April, but then we think that the silver price will rise more sharply. We're looking at 600 plus million ounces of open interest in the May Comex contract. Shades of 2011, when we saw about 350 million ounces of May Comex open interest, which had to roll into July. And as it did, the price went from about $35 an ounce to $50 an ounce. And then within the first 5 days of May, it came back down to about $32 an ounce, because it wasn't that investors were buying silver that drove the silver price high in April of 2011. It was the May Comex roll. That's where the purchasing of silver in the May contract was occurring. Silver coins, silver ETFs actually were not big purchasing areas of silver. Yeah. So I won't even get into the latest scam, which is the Silver Squeeze 2025, where everybody's supposed to buy silver and drive the price of silver higher next Monday. I will point out that when other scammers promoted the idea of buy silver, drive the silver price higher, and drive JP Morgan into bankruptcy, what happened was that JP Morgan earned more money on the silver that it owns, because it's not short silver, it's long physical silver, hedged with Comex silver positions. I know some people cannot understand that or refuse to understand it because of delusions that they have, that they hold so deeply. But that's the case. The last time somebody tried that, get the fools that don't listen and don't understand to buy silver, and we'll bankrupt JP Morgan. JP Morgan had record profits in its gold and silver trading positions that year. So, hey, you can believe it if it helps you to sleep, but making money has been my preferred way of going. Platinum and palladium, they have risen over the last few days, but they are staying range bound, and they probably will stay range bound. They could actually fall because we probably are going to be seeing much weaker auto production and auto sales. And if you're not making automobiles, you don't need the platinum and palladium and rhodium that you normally have. So that's where we are. A lot of the information I just gave you is in the 2025 Gold Yearbook. You can go to our website and you can buy it. You can download it. It's an ebook. You can have it printed out and bound if you want, or you can just print it out and read it. You can learn a lot about what's really going on in the gold market. You can understand its investment demand that's been driving gold prices higher last year, that central banks actually bought 40% less gold last year than they had bought in 2023. And you can learn a lot of other things that are very important and very real in the gold market. We'll be coming out with our silver yearbook in the middle of May and our platinum yearbook in late July. You can go to our website. You can order the gold yearbook, pre-order the silver and platinum yearbooks. You can buy other research that we sell. You can see all sorts of free reads and free videos. And you can send us an email at info@cpmgroup.com to talk about how we can help you better manage your price exposure with commodities and precious metals. That's all I have for now. Have a good weekend. Take care of yourself. Take care of those around you. Try to do something good for the world, because there are a lot of people out there trying to do bad things for the world right now, and we really need to counter them. Take care.